Hi everyone, today we'll be going over accounts, May June 2022, paper 2 question number 1. This is structured paper 2, which consists 4 questions, 2 of 30 marks and 2 of 15 marks, and we are also given a time limit of 1 hour 30 minutes. And since question number 1 is of 30 marks, we will be attempting to solve this question under 30 minutes. Now, without any further delay, let's get started. Karen and Lee are in a partnership, sharing profits and losses in the ratio 2:3 respectively. And the following balances were available at 28 February 2022, meaning that this is the closing date. Okay, then we are given some additional information as well. Let's have a look at the first question. For the first part, we need to prepare the income statement for the year ended 28 February 2022. And we have to use the space provided on the next page for your workings. But I will be doing my workings in the question paper itself, but make sure that you guys do it in the given working space. Okay, in order to prepare the income statement, let's first look at these sets of information. On 28 February 2022, inventory had been valued at a cost 21,220. So we're talking about closing inventory since 28 February 2022 is the closing date. Then this figure included some damaged items which had cost 1,320 and had a sales value of 2,480. Then the damaged items could be repaired at a cost of 1,300. Okay, so we need to adjust and figure out our new closing inventory value. So that's closing inventory. Okay, so we had the original cost of 21,220, and we also know that this figure included some of the damaged items which had the cost 1,320. So damaged items should definitely be reduced from our closing inventory. This value should not be included, so we're just going to subtract the value of 1,320. But we also know that this damaged value had the sales value of 2,480, and this damaged goods could be repaired at a cost of 1,300. So if this goods can be repaired, then that value should definitely be included in the closing inventory. And whenever we're talking about repairment of damaged inventory, then the value that should be included is the difference between its sales value and the repair cost. So let's include our sales value, which is 2,480. And we should also reduce the cost of repairment, right, which is given as 1,300. So let's subtract that value. And this will give our new inventory valuation. So that's just going to be 21,220 minus 1,320 plus 2,480 minus 1,300, which results in our inventory value to be 21,080. Now for the second information, in January 2022, an error had been made recording return inwards 410. This amount had been credited to the returns outwards account. So instead of including this value of 410 in return inwards, this value was actually included in our return outwards. So let's correct this error. So we have return inwards and return outwards. Okay, we should have actually included the value of 410 in return inwards, but it was actually included in return outwards, which means that we just have to add the 410 value back to return inwards, whereas subtract the value of 410 from our return outwards in order to correct this error. Okay, we are given our returns right here, and we're given the values for the debit side as well as the credit side. And we know that return inwards is a kind of loss to our business because we are making the sales and the sales is being returned. So that's the return inwards, right? It is related to sales, whereas return outwards is related to purchases. So the return related to sales will be recorded on the debit side, which means that our return inwards value is 2,200. Let's write it down. And we need to add the value of 410 back to this value. So that's plus 410, which results in our new return inwards value to be 2,610. Then the credit side will be the returns value relating to purchases, which is the return outwards value. So that's 3,930. And we need to subtract the value of 410 from this amount. So that's minus 410. This results in the return outwards to be 3,520. All right, let's move to the third information. Insurance includes 1,410 paid for the 3 months ended 30 April 2022. So these 3 months are April, because this is the last month, then the month before April, that's going to be March, and the month before March, that's going to be February. So 1,410 is the insurance paid for these 3 months. But what we know is that our year end is 28 February 2022, right? Which means that all of our expenses and income should only be recorded for the year ended 28 February 2022, meaning till the end of February, right? So we do not actually include our incomes and expenses relating to the future months in our income statement. So we only have to include the insurance cost of 1 month. Okay, so let's figure out the insurance for 1 month. If the insurance cost for the 3 months is 1,410, we can just use the unitary method and divide it with 3 in order to figure out the insurance for 1 month. So the insurance for 1 month will have the value 1,410 divided by 3, which is 470. Alright, then we need to adjust this to our insurance cost given in the trial balance. We need to deduct this insurance payment of 3 months and add back this insurance payment of 1 month. Let's do that. Okay, we have our insurance right here. Originally, it had the cost of 7,740, and this includes the value of 1,410 relating to 3 months. We need to deduct that. So that's minus 1,410, but we also need to add back the insurance cost for the month of February, right? And it amounted to 470. So let's add it back. Now this gives our new insurance cost to be 7,740 minus 1,410 plus 470, which results in 6,800. This is the value of insurance to be recorded in our income statement. Alright, let's have a look at another information. The loan from Lee had been arranged on 1st November 2021. It was agreed that Lee should be entitled to interest at 6% per annum on the loan, and no entries had been made for interest on the loan. So we need to figure out the interest on the loan from Lee. Since the loan was arranged on 1st November 2021, let's figure out the months that we use this loan. So that's going to be November, December, January, and February, because February is our year end. So we use this particular loan for 4 months, meaning that the interest should also be charged for 4 months. So interest on Lee's loan is just going to be the value of the loan. Let's have a look at the trial balance for that. We have our loan from Lee right here, and this amounted to 10,000. Let's write it down. So that's 10,000. And we have the interest rate of 6%, so we can just multiply it with 0.06. This will give the interest for 12 months, but we only require the interest for 4 months. That is why we will multiply it with 4 and divide it with 12. Now this gives the interest on Lee's loan for the 4 months to be 10,000 times 0.06 times 4 by 12 to be 200. Okay, then we have the provision for doubtful debts should be increased to 310. So this is our closing provision for doubtful debts. Let's have a look for the opening one. Okay, we are given provision for doubtful debts right here. It's 1st March 2021, which is the opening date, and it had the value of 260. But we can see that we are increasing our provision for doubtful debts to 310, meaning that there is an increase in provision for doubtful debts, and the increment in provision for doubtful debts is always an expense, so this value will be recorded in our income statement for doubtful debts. So this is just going to be the year-end value of provision for doubtful debts minus the opening value of provision for doubtful debts. That's 310 minus the opening value was 260. So the increase in provision for doubtful debts is 310 minus 260, which results in the value of 50. And this will be recorded under the expense in our income statement. Alright, then the non-current assets are to be depreciated by 20% per annum using the reducing balance method. Okay, let's figure out our depreciation as well. So we can write it right here, depreciation on non-current assets. We know that it is being depreciated using the reducing balance method, which means that we need to apply our rate to the net book value, and the net book value is the difference between the cost and provision for depreciation. So let's write it down first. We are given our information regarding non-current assets right here. The cost of the non-current assets is 160,000. So that's 160,000. And we need to subtract our provision for depreciation in order to figure out the net book value. And we can see that the provision for depreciation is 56,000. So that's 56,000. And this will give the value for our net book value. Now we can multiply it with our rate of depreciation, which is 20%, and we can write it down as 0.20. So the depreciation on non-current assets is going to be 160,000 minus 56,000 times 0.20, which results in the value of 20,800. Alright, since we completed all of the information, now we can move towards preparing our income statement. Okay, we will first start with the revenue. Let's have a look at our trial balance. We can see the revenue right here, and it amounted to 229,250. Let's write it down. I'm going to write the value in this column since we know that there is also a return inwards and we need to subtract it in order to figure out our net revenue. So that's 229,250. Then we need to subtract our return inwards. That's the sales returns. Let's have a look above. So we figured out our correct return inwards right here, and it amounted to 2,610. Let's write it down in our income statement. That's 2,610. And we need to deduct this amount. So after deducting the returns inwards from revenue, we will get the net revenue value. Let's figure that out. That's going to be the sum of these 2 months. So that's 229,250 minus 2,610, which results in the value of 226,640. So that's 226,640. Okay, then the next step would be the cost of sales, and we need to subtract this. So that's cost of sales. And we always start with our opening inventory. Let's have a look at our trial balance to figure out the value for our opening inventory. We can see inventory at the date of 1st March 2021, which is the opening date, meaning that this is our opening inventory. And the value is 8,250. Let's substitute this to our income statement. So that's 8,250. Then second step would be to add our purchases. Again, we'll have a look at the trial balance to figure out the value for purchases. We have our purchases right here, and it amounted to 151,440. Let's substitute this value in our income statement. That was 151,440. Okay, and we also know that there was returns outwards, which is the purchases returns, and that needs to be deducted from the purchases. So that's less return outwards. Let's have a look above. We calculated our correct return outwards right here, and it amounted to 3,520. Let's substitute this value. That's 3,520, and since we need to subtract this value, I'm just going to put it in a bracket. Okay, let's look at the trial balance to see if we have carriage inwards. Alright, carriage inwards is right here, and it had the value of 3,880. So this is an expense, which means that this should be included in our cost of sales. Let's write it down. So let's add carriage inwards with the value of 3,880. And finally, we need to subtract our closing inventory. Let's have a look above. We adjusted our information and figured out the correct closing inventory right here, and this amounted to 21,080. So let's substitute this value. That's 21,080. And since we're subtracting the closing inventory, I'm just going to put it in a bracket. Alright, now we can figure out our total for the cost of sales by adding these 5 amounts. So that's 8,250 plus 151,440 minus 3,520 plus 3,880 minus 21,080, which results in the value of 138,970. And since we need to subtract this cost of sales from our revenue, I'm just going to put it in a bracket as well. Alright, so we have our net sales as well as the cost of sales, which means that we can now easily figure out our gross profit. And the gross profit is just the difference between the revenue and cost of sales. In this case, that's 226,640 minus 138,970, which results in the value of 87,670. That's the gross profit. Alright, now let's have a look above to see if we have any kind of incomes, because we need to add the income to our gross profit. And we know that incomes are always recorded on the credit side, so let's have a look. This is a bank overdraft, not an income. These are capital accounts, and this is a current account. And we have trade payables. Again, that's a liability, not an income. So we can conclude that there is no income. Now we can jump towards our overheads. And we need to subtract all our overheads from the gross profit. So that's less overheads. Alright, let's have a look at the trial balance again to figure out our overheads. The first one is definitely the administrative expenses, and this amounted to 6,020. So let's include it in our overhead section. That's administrative expenses with the amount of 6,020. Let's have a look at the trial balance again. Then we have our bank interest charges, which amounted to 180. This is an expense as well, right? So we need to include it in our overhead section. Let's do that. We have bank interest charges of 180. All right. Then we have bank overdraft, that is a liability. We have capital accounts, current accounts, drawing accounts, which is not included. Then we have our insurance. Insurance is an expense, right? And we figured out the correct value for insurance to be 6,800. So we need to record this in our overhead section in the income statement. Let's do that. So that's insurance charge of 6,800. All right. Then we already included our opening inventory, and we have loan from Lee, which means that we also figured out our interest on loan from Lee, and that is also an expense. So we need to include this in our overhead section, and this amounted to 200. Let's write it down. So interest on loan from Lee, it was 200. Okay. Then we have our non-current assets. We already included that. We have provision for doubtful debts, and we had an increment in the provision for doubtful debts, which is an expense, and this amounted to 50. Let's include this in our overhead section. So increase in provision for doubtful debts, and this amounted to 50. Okay, let's have a look above. Then there's revenue, trade payables, trade receivables, suspense account. Okay, we included everything. No, we didn't include the depreciation, and that is an expense as well, which needs to be recorded in our overhead section. And the depreciation on non-current assets, we figured it out to be 20,800. Let's include it in our income statement. So that's depreciation on non-current assets with the amount of 20,800. Okay, now we can figure out our total overheads by adding these six amounts. So that's 6,020 plus 180 plus 6,800 plus 200 plus 50 plus 20,800, which results in the value of 34,050. And since this is the total overheads which needs to be deducted, I'm just going to put it in a bracket. Okay, now we can figure out our profit for the year. By subtracting this overheads amount from our gross profit. So let's have a look above. We know that we have our gross profit to be 87,670, and we need to subtract this amount of 34,050 in order to get the profit for the year. That's 87,670 minus 34,050, which results in the profit for the year to be 53,620. Okay, so this concludes our income statement as well as the first part of this question. Now we can move to the second one. Again, you guys should be doing all of your workings in this workings box rather than scribbling all over the question paper like I did. Okay, then for the second part, we need to prepare Lee's current account for the year ended 28 February 2022. Alright, let's have a look at our trial balance to see our opening value for the current account of Lee. So current accounts is given right here, and for Lee, it was the amount of 1,880 on the debit side. Okay, the current account value on the debit side actually indicates the value that the partner needs to be paying back to the business, right? So this is something that reduces the balance on the current account, which means that this opening balance on the debit side will always be included on our current account on the debit side as well. Let's write it down. So on the debit side, we have our opening balance, balance BD. Let's have a look above to see what the balance was. It was 1,880. Let's write it down. Okay, now we just need to include all of our items that are to be included in the current account. The first one is drawings, because drawings is something that needs to be repaid back to the business. And for Lee, the drawings taken was 19,900, and this needs to be repaid, which means that this actually reduces the balance on the current account. And the reduction in the balance on the current account is always to be recorded on the debit side. So this drawings of 19,900 will also be recorded on the debit side. Let's do that. So that's drawings with 19,900. All right, then let's have a look above. Okay, Lee gave a loan to the partnership business, right, on which he will receive a certain amount of interest, and that definitely increases the balance on the current account because he is receiving some amount from the business. So that should be recorded on our credit side, and we know that our interest on Lee's loan was 200, and this is the value he will receive from the partnership. So this value should be recorded on the credit side of our current account under the heading of interest on loan. Okay, so that's interest on loan with a value of 200. Then there was profit, which means that profit and losses should be shared among Lee and Karen, right? And the share of profit is something that Lee will receive from the partnership business, meaning that this value of the profit will definitely increase his balance on the current account. So this share of profit should be recorded on the credit side of our current account. Let's figure out the share of profit for Lee. And for that, we first need to figure out the profit sharing ratio, which is 2:3. So out of 5 parts, 2 parts will be received by Karen and 3 parts will be received by Lee. And we only need to figure out the share of profit for Lee. Let's do that. So share of profit for Lee. So we have the total profit of 53,620, and out of 5 parts of this value, 3 parts is to be received by Lee. So that's just times 3 by 5, and this gives the share of profit for Lee to be 53,620 times 3 by 5, which results in 32,172. So this is the value of the share of profit to be recorded on the credit side of our current account. Let's do that. So that's share of profit, and the value is 32,172. All right, now we can figure out our closing balance. We can definitely see that the balance on the credit side is heavier one, which means that our balancing figure should be on the debit side, and the balancing figure is our closing balance. So that's balance CD. Now, in order to figure out the balancing figure, we first require the total value. So we will figure out our total for the current account from our credit side. So that's the sum of these two amounts, which is 200 plus 32,172, which results in 32,372. And the total will be the same for the debit side as well. Now we need to figure out this balancing figure, and whenever we're trying to figure out the balancing figure, we just have to deduct these amounts from the total. So in this case, that's 32,372 minus 1,880 minus 19,900, which results in our closing balance of the current account to be 10,592. And we know that this closing balance for this year will act as an opening balance for the next year. So we need to record it as the opening balance for next year. That's balance brought down on the opposite side, which is the credit side now. And this amounts to 10,592. And since our opening balance is now on the credit side, we can see that this is the balance that the partnership owes to Lee. Alright, this concludes the second part of this question. Now we can move towards the third one. We are given additional information. The partners have been considering making a more detailed partnership agreement to include the following terms. The first one is that interest is to be charged on all drawings at 10%. So interest on drawings is something that the partners need to pay to the partnership account. This definitely reduces the balance on our current account, which means that interest on drawings should be recorded on the debit side along with the drawings amount. Then Karen is to receive a salary of 8,400 per annum. So these interest on drawings and salary definitely changes the residual profit, right? So for that, we need to figure out the interest on drawings for both Karen and Lee. And it is 10% of the drawings amount. So let's have a look at our trial balance. Okay, we have drawings right here. So the drawings for Karen is 17,500 and we only require 10% of it as the interest. So that's just going to be 17,500 times 0.10, which results in 1,750. Then for Lee, that's 19,900 times 0.10, and this results in the value of 1,990. So these are the interest on drawings for Karen and Lee respectively. Let's write it down. 1,750 and 1,990. So that's 1,750, 1,990. Okay, now we can figure out our new residual profit. We will start with our existing profit. So let's have a look above. We can see that the profit for the year was 53,620. So that's 53,620. And we will be adding back our interest on drawings to this amount because interest on drawings are something that the partnership will receive from the partners, right? So that definitely increases the profit. So that's plus 1,750 plus 1,990. And we also have a salary, and salary is something that is paid out from the partnership, meaning that the profit will be reduced by this amount. So that's minus 8,400. Alright, this gives our new residual profit to be 53,620 plus 1,750 plus 1,990 minus 8,400, which results in the new residual profit to have the value of 48,960. And we are also told that profits and losses would continue to be shared in the ratio Karen to Lee 2:3 respectively. Okay, for the third part of this question, we need to calculate the increase or decrease in Lee's current account balance at 28 February 2022, assuming the new agreement had been in use from 1st March 2021. Okay, so for this, I will be preparing the current account for Lee again. So that's Lee current account. And this is the debit side and the credit side. So our opening balance will not be changed. So we can write this value of 1,880 on the debit side as the opening balance. So that's balance BD 1,880. And the drawings amount also remains unchanged. So we can record our drawings of 19,900 on the debit side. And we know that there is interest on drawings now. And interest on drawings is something that the partners need to pay back to the partnership, which means that this amount actually reduces their current account balances. So the interest on drawings will always be recorded on the debit side. And for Lee, the interest on drawing is 1,990. So let's record it on our debit side of the current account. That's interest on drawings. That's 1990. Okay. Then we also had the interest on loan provided by Lee to the partnership account. This does not change, so we can record this value of 200 on our credit side. That's interest on loan, 200. Then we also have the share of profit. Now we need to figure out the new share of profit based on our new residual profit. So let's figure that out. Share of profit for Lee. We'll start with our residual profit of 48,960. And out of 5 parts of this amount, 3 parts is of Lee. So that's just times 3 by 5. Now this gives new share of profit for Lee to be 48,960 times 3 by 5, which results in the value of 29,376. Let's record this. That's 29,376. Okay, now we can again see that our credit side is obviously the heavier side, which means that our balancing figure will be on the debit side, and that will be balance CD, which is the closing balance of the current account. Now, in order to figure out the closing balance, we first require the total. So we will just total our credit side. That's the sum of these two amounts. That's 200 plus 29,376, which results in the value of 29,576. And the total is the same for debit side as well. Now, this closing balance of the current account will act as our balancing figure. And whenever we're trying to figure out the balancing figure, we just need to subtract these amounts from our total. In this case, that's 29,576 minus 1,880 minus 19,900 minus 1,990. And this results in the balance for the closing balance to be 5,806. And this will act as our opening balance for the new year. So that's balance BD with the value of 5,806. And the question asks us to calculate the increase or decrease in the Lee's current account balance. So the new current account balance is 5,806, whereas the previous current account balance was 10,592. So we can see that the new current account balance has definitely decreased, right? So let's figure out the decrement in the current account balance. This will just be the difference between the previous current account balance and the new current account balance. And we know that the previous balance was 10,592. Let's write it down. Minus the new balance of 5,806. And this gives the decrement value to be 4,786. Okay, so this concludes the third part of this question. Now we can move towards the fourth one. We are given additional information. Karen and Lee had also considered operating as a limited company. Now, we need to explain one advantage of operating as a partnership rather than a limited company. So what we know is that partnership has fewer legal requirements, which will result in fewer costs. So that's an advantage of operating as a partnership rather than a limited company, because the legal procedure for a limited company is very complex, and that will result in a higher cost. Let's write it down. Fewer legal requirements, which means it has fewer costs. Alright, this concludes the fourth part of this question. Now we can move towards the fifth one. We need to explain two advantages of operating as a limited company rather than a partnership. So we know that there are partners in a partnership, whereas there are shareholders in a limited company, and shareholders actually have limited liability rather than the partners in a partnership who have unlimited liabilities, meaning that in case the company gets wound up, then the shareholders would only lose their investment and not their personal assets. So that's definitely an advantage. Let's write it down. Shareholders enjoy limited liability for debts in the case of company being wound up, and they would only lose their investment in the company. Then partnership will only get their investment from the partners, whereas limited liability can increase the number of shareholders by issuing additional shares, right? So let's write it down. Limited companies can access larger amounts of finance through the issue of additional shares. Okay, so this concludes the fifth part of this question. Now we can move towards the sixth one. We are again given additional information. The partners are concerned about the business's liquidity position, and Karen believes that the problem arises because the business holds too much inventory, and she suggests that the credit purchases should be reduced for the next 3 months to ensure inventory levels are lowered. Now we need to advise Lee whether or not he should accept Karen's suggestion, and we need to justify our advice. So the first thing that we need to understand here is that the proposal is to reduce the credit purchases for the next 3 months. And if we reduce credit purchases, it means that we are reducing our purchases overall, right? And that will definitely reduce the cash outflow. Let's write it down. Will reduce cash outflows. Then since we're reducing our purchases, it means that the carriage inwards will also be reduced, and in turn the storage costs will also be reduced, right? Let's write it down. Costs may be saved through less expenditure on storage and carriage inwards. But we also know that we're talking about credit purchases, right? And we are given trade discounts on the credit purchases. So if we reduce our credit purchases, then we could also lose the trade discounts. Let's write it down. Business would lose valuable trade discounts and we are reducing our credit purchases in order to lower our inventory levels, right? And if we reduce the inventory levels, there is always a risk of running out of inventory. Let's write it down. Risk of running out of inventory of popular products. Okay, now based on these factors, we now need to advise Lee whether or not he should accept Karen's suggestion. Personally, I would advise Lee not to accept Karen's suggestion. So let's write the decision clearly. Lee should not accept Karen's suggestion. Okay, this concludes the sixth part of this question as well as this entire question. If you found this video useful, make sure you like the video and leave a comment below. And make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.